I don't think that the dynamic that we saw when the Fed started cutting rates in September and the 10-year yield went straight up was an anomaly. I think that was an important signal about the backdrop that we're in right now. Now, obviously, I would argue the Fed had no business cutting rates back then to begin with, but I think that the bond market is clearly very edgy, let's say, about the fiscal situation and not getting into a repeat of the 2020 COVID era stimulus, helicopter money, etc. I think the thing that would get yields significantly lower would probably be if we had an absolute 2008 style meltdown in the stock market, at which point you might have people say, I want risk off. And even though the deficits are going to go up, bonds look more attractive to me than stocks. I mean, and it would have to be really nasty. And again, what the floor on yields is would probably be significantly higher than had been previously, especially since the fiscal response would be so much larger. But we would also not be alone in that. I assume it would be like 2008, a global situation. So you might have, some foreign capital, but I'm really at this point, as you can tell, struggling to come up with a scenario where our bond yields really decline in any meaningful fashion. This is what I was going to say is that, maybe you can't see stocks going down 50% nominally, but in real terms, deflated by gold, that seems like you could do that very easily, you know? So that's important. I'm maybe a little defensive about the feedback I get on Twitter and other platforms when I talk about my bearish views on the stock market, because I get completely tarred and feathered for having missed the rally in the market. Meanwhile, I just checked this morning, gold's up 40% over the last year and the S&P is up 11. So, okay, I'm sorry I missed the 11% move in the S&P because I decided I'd prefer to own gold. But that's the thing is like we live in a nominal society and people look at everything, their stock portfolios and the economic data in these nominal terms, and they don't adjust anything for what's happening to their purchasing power. Although it comes home to roost when you start to actually have to pay bills and you realize, I'm only getting, I thought 5% return on my money market was great until inflation was 9%. And then all of a sudden it's not going as far as it was before. So to the junior miners, because, I figured they were just a levered bet on gold. So if I think gold's going to go higher, I should position that. Also, they have so much catching up to do with the price of the bullion. I mean, if you look at just the gold miners, the GDX relative to the price of gold, I mean, it's barely started to move up off of multi-year extreme lows. So there's a lot of room for these stocks to move. I mean, they could easily double, and with gold going nowhere from here. So that's the case for them. But, they're speculative, and the mining industry, the gold miners, are legendarily poor management. So you got to kind of hold your nose on that score and hope that the price of gold can overcome the abysmal management of these companies. But we're there, at these numbers, and especially with oil going down, their cost of production with oil going down is even more compelling. Yeah, I do not, because I am not interested in, so I don't think it can go up. I think it absolutely should. And that's another one where relative to gold, it looks like it should be substantially higher. And I've also read that the shortage of silver is probably even more egregious than the shortage of gold in terms
certainly
of
above ground.
Availability for delivery. So if we saw something in the silver market like we saw, right around the imposition of tariffs in gold, where there was this massive rush to take delivery of physical, that could be a precipitating event for silver to move much higher. Frankly, I think all of the precious metals are interesting here just because, in my view, we're talking about an environment where it's not just the dollar that's at risk. All fiat currencies are going to be debased. I just don't see how we get out of this current global economic framework without a complete monetary reset. That being my outlook, I think that any hard asset, particularly precious metals, real estate, I'm a little disinclined for reasons that are probably unique to our particular situation here in the US right now. But I would say hard assets in general would be my preference in a environment where it seems like it's just a matter of time before we get into another one of these races to the bottom in terms of global currency debasement. The one thing I would say about the Trump presidency is that I welcome, other people hate the uncertainty from day to day. One day the tariffs are on, the next day they're off. One day they're 140%, the next day they're 12. It's like, and the market's getting ping ponged back and forth and back and forth. And I happen to relish it because I feel like we lived in this fabricated environment where interest rates were repressed and everything was handed to them on a silver platter. Analysis was completely irrelevant. You don't really have to be an analyst anymore. For the longest time, you could throw darts at a dartboard and pick a great stock and make a ton of money. So now we're actually having to get back and do homework and roll up our sleeves and understand what's happening here. And I find that refreshing and gratifying. For me, when you started the conversation about institutions that were going to be dismantled and disappear and be rewritten, the one thing that kept going in my head was the advent of central banking, Federal Reserve, global central banks, controlling the means by which we conduct business and trade. Like, why is that an institution that should persist? As you just said, the purchasing power of the dollar has been destroyed since the day the Federal Reserve was founded. So that strikes me as the most obvious institution that would be the first to go away. But that's just, again, Grant would chastise me because I'm thinking about things that I know and feel confident about, and I'm not pushing my mind to imagine anything farther beyond that. But that was the one specific institution that I felt like I can absolutely see that happening, and probably in a reasonably near time horizon. I'm not talking about the next year or so, but certainly within the next decade, we could see an entirely new monetary regime globally. This is the one thing that the Fed has demonstrated it actually is good at. They don't seem to be good at very much, but destroying the purchasing power of the currency, they have proved to be excellent and reliable at. So there was something about Harvard's liquidity event, and I think that's really interesting because, we're talking about the student loan repayments kicking back in, having consequences across the consumer space. It's interesting how policy actions can have unintended consequences. So, the restatement of student loan payments is having all these knock-on effects that maybe had the administration realized that was going to happen, they might have maybe progressed it more in phases or something like that. I don't know how they would have done it, but Harvard and the elite Ivy League colleges in general are all now in the headlights of the administration at a time when, I don't know if you saw this, Bill Ackman was interviewed and he was talking about this issue where Harvard has been kind of cherry-picked by the administration as being a target, and they pulled the federal funding. And he went through the numbers of Harvard's endowment, and he basically said that of the $53 billion endowment that Harvard has, 85% of that money is in illiquid alternative assets, private equity, venture funds, etc., real estate, what have you. And that the marks on that 85% of their portfolio are probably inflated by a magnitude of about 40%. That was his conservative kind of general number was, you'd mark them down 40% across the board. So Harvard and these other institutions that have these massive endowments really don't have anywhere near the amount of money that they appear to have. This seems to be a theme in what our economy right now, whether it's the credit quality of the consumer or businesses, or even the elite, educational institutions, academic institutions. And so you've reached a point where this happened over a year ago, where Harvard and I think Stanford also had to go out and raise money. They borrowed money in the capital markets because they needed money to continue paying interest on their debt and fund operations, and they weren't getting any income off of these illiquid assets that they had put all their money, because right now these private equity firms are sitting on these garbage portfolio companies that are basically bankrupt, and they're doing the extended pretend, but no one's generating any income. So it's leaving all the investors, the LPs in these funds like Harvard, etc., to go out and drum up money elsewhere to replace the cash flow that they expected to be thrown off of these investments. So this could be another precipitating event. The elimination, if they actually are able to pull funding from these institutions, guaranteed those institutions are going to rethink the share of illiquid assets that they hold in their endowments and maybe try to get out. Obviously you don't want to take a 40% hit, but at some point you need to do something. But what's happening is that the big players now they call this creditor on creditor violence, where the people who have, seeded those portfolio companies, now that they're doing these extend and pretend games and the companies are coming back and saying, we still need more money, the big wig creditors are basically negotiating sweetheart deals for themselves to the detriment of all the other creditors down the chain. And those creditors down the chain are the unsophisticated pension guys who don't realize they need to have a seat at that table when the conversation takes place about how are we going to restructure this debt and can we get ourselves a decent deal rather than getting the shaft. So this is going on behind the scenes right now. And that's one thing that's holding this whole ball of wax together, is that the big players are actually content because they're negotiating nice deals for themselves. But in the process, they're screwing over all of the people at the lower end of the chain. So at some point, the people below them, the lower rungs, are again going to say, we don't need this. We're not going to do this anymore. We want out, or we need out, as the case may be. So I hate to try to forecast direction and time, because God knows I've been predicting this corporate credit bust for long enough, but things are getting very dicey in that space. And when Bill Ackman comes out and says everything deserves a 40% haircut, I think it's time to sit up and take note.